The Federal Reserve System, also known as the central bank, also known as the Fed. The Federal Reserve primary function is to regulate all banking institutions who are a member of the Federal Reserve System. It is organized by a chairman who is appointed by the United States President and confirmed by the United States Senate. The chairman or chairwoman works along with the Federal Open Market Committee. The two of these individuals or groups working together establish monetary policy. Monetary policy is when a central bank, in the United States case, the Federal Reserve, control the amount of money or overall interest rates if the economy is struggling or inflating. If the economy is struggling, then the Fed may decide to engage in expansionary monetary policy. That means they may decide to increase the money supply. The Fed also referred to this as quantitative easing. If the economy is running too hot or it's inflating, then the Fed may engage in contractionary monetary policy. In other words, the Fed may decide to decrease the money supply. The Fed also referred to this as quantitative tightening. How does the Fed influence the money supply or its reserves? Well, the Fed has three tools at its disposal. The first is the reserve requirement. The second is when the Fed lends to banks. And the third are open market operations. The first is a reserve requirement. Let's recall Big Money Bank. Big Money Bank is a retail bank that has businesses and individuals deposit into their checking account at their bank. If you need a refresher on the role of the reserve requirement and checkable bank deposits, I would suggest and encourage you to watch my Banks and You video. But back to the Fed. Let's say that the economy is headed into a recession, and in order to improve the economy, one of the solutions is to increase the money supply. Well, the Fed can reduce the reserve requirement, which allows the banks to lend out more money. As a result, this increases the money supply due to the increase in lending. This also works in the reverse. If the economy is running too hot and inflation is becoming more of a threat, then the Fed can increase the reserve requirement, thereby reducing the lending performed by the banks and reducing the money supply. A second way that the Fed controls the money supply is when the Fed lends to banks. Well, why would a bank require a loan from the Fed? Sometimes banks are in need of reserves if they fall short of the required amount. If this were to occur, then the Fed can lend funds to the bank to make up the difference. So let's say that the Fed decides to give a loan to a bank. Well, there is always interest attached to a loan, and this interest is referred to as the discount rate. The discount rate is the interest rate that a central bank charges to banks. So if the Fed decides to reduce the discount rate, this allows the banks to increase their lending, therefore increasing the money supply. The same is also true in the reverse. If the Fed increases the discount rate, then the bank's lending will reduce, therefore reducing the money supply. The discount rate is the least practice of monetary policy. The reason being is that when the banks ask the Fed for money, it's like asking your parents for money. after they have just gave you money the day before. If the bank is unable to maintain required reserves in the vault, then it sends a signal to the Fed that there may be mismanagement at this bank, or worse, the bank is on the brink of closure. Therefore, most banks tend to borrow from each other. And when they perform this, again, an interest rate is placed. This rate is known as the federal funds rate. It is the interest rate that banks charge other banks for overnight lending. Banks perform this in what is known as the federal funds market. It is a marketplace that allows banks to borrow funds from each other if a bank falls short of the reserve requirement. So who determines the federal funds rate? The banks themselves? Well, sort of. The Fed, mainly the Federal Open Market Committee, cannot simply force these banks to utilize this federal funds rate. So what the Fed does is establish a target federal funds rate. And by establishing that target, then the banks can follow suit with establishing their own rates. The third and most common utilized monetary policy is referred to as open market operations. Open market operations is when the Federal Reserve buys or sells bonds or securities. A bond is basically a debt or an IOU. Everyday individuals buy bonds as an investment. So let's say that you buy a bond that is worth $500 of government debt today. Over time, let's say 15 years later, the bond builds interest, and at a certain time, you will be able to gain more money for the purchase from that $500 bond. Now, I said before that anybody can purchase a bond from a bank. But when the Fed does it, they purchase these bonds from investment banks. These are banks that focus primarily on the purchase of stocks and bonds. So how does open market operations determine the money supply? Or how some economists phrase it, the monetary base? Well, let's once again look at Big Money Bank and a T-chart or balance sheet to show this. In front of you, you have once again Big Money Bank, and they have $100 million in liabilities, and their assets are broken down in its respective categories. Well, let's say that the Fed decides to buy a bond of $10 million from an investment bank. Well, Big Money Bank has bonds or securities valued at $10 million. When the Fed purchased this bond, currency or cash is given to the bank. And as a result of that cash being given to the bank, instead of it going into deposits, it goes directly into the bank's excess reserves. So as a result, that $10 million that was at securities are now considered to be cash in the bank's excess reserve, increasing it to $40 million. What then can banks do with that $10 million in excess reserves? If you guessed lent it out, then you guessed correctly. The $10 million is lent out, let's say, to a business. And that business also banks with Big Money Bank, and they deposit that $10 million into Big Money's bank account. Well, that $10 million is deposited under Big Money's bank liabilities, and then the required reserves increase to now $11 million, which this changes the entire composition of assets for Big Money Bank. Big Money Bank now has $39 million of excess reserves and now $60 million in loans. With this process, the money-making process continues, and it also increases the money supply. Therefore, quantitative easing. But now, let's say the Fed decides to reduce the money supply. Once again, we're back at Big Money Bank. And when the Fed sells a bond to investment banks, those excess reserves reduce. So we're still at $100 million for liabilities, but we are no longer at $30 million for excess reserves, and the securities amount has increased to $20 million. And if you recall, both sides must balance as a result of this sale of government bonds. You guessed it, the money supply decreases. And this, ladies and gentlemen, is known as quantitative tightening. So there you have it, the three tools that the Fed uses to influence the money supply: reserve requirements, the Fed lending to banks, and open market operations.